Welcome to another episode of the Einstein Retirement Daily, where we cover topics and news items and things that are happening in the markets or in the news that affect today's retiree. As always, if you hear something in today's podcast that causes you to want to take some action or make changes, please do not take any action without consulting the appropriate tax, legal, or investment professional who knows your specific situation prior to making changes. In today's episode, we're going to delve into a very common retirement question, and that is if I transfer dollars or assets from one account to another account, do I pay taxes for that? So here's a few scenarios. Scenario number one, I take dollars from my existing IRA and I roll it into another IRA. Is this a taxable event? No, it is not. Going from an IRA to an IRA is not a taxable event, so long as the dollars transition directly from your existing custodian to your new custodian. A custodian, of course, is the holder of the funds, and that's going to typically be a bank, a big brokerage institution, or possibly an insurance company are going to be kind of your three most common custodians of funds. Okay, so that is a non-taxable event, so long as you go from an IRA to another IRA, and those two IRAs, you are the owner of both of those IRAs. If you take an IRA that you're not the owner of and you put it in your IRA, well, you can't, okay, it's not allowed, but there's going to be different tax ramifications for that unless you're receiving that, say, as a spousal inheritance, for example. Okay, what's another scenario that's a very common transition of funds that is not a taxable event? If you take dollars from a Roth IRA and transition to a Roth IRA, same deal as the IRA, no taxes for that. What if you go, though, from an account that is not of exactly the same type? So you want to go into an IRA as your final destination, but let's say you're pulling funds from a 401k or a 403b or a simple IRA or a SEP IRA or some of these other differently titled accounts. Well, the key is that if the dollars were contributed into the account pre-tax, meaning there was no taxes paid on those dollars before they went into the 401k or the IRA or the simple or the SEP IRA or the 403b or the TSP or the TIAA. Okay, these are called qualified accounts. If you have a qualified account that you're transitioning out of that qualified account and into an IRA account, this also is a non-taxable event. There are not going to be any taxes due for that, again, so long as you're the owner of both of these accounts. So that's another non-taxable situation. Okay, the last non-taxable situation that I'm going to focus on here has to do with transitioning dollars from a brokerage account or a savings account or a checking account. In our business, we would call these dollars non-qualified dollars, non-qualified, meaning not IRA, not Roth IRA, not 403b, not 457, none of those types of special designations. It's effectively just cash that you've either invested or it's cash. So long as the dollars transition as they are today to the new custodian of funds as they were, then there's no taxes. Here's an example. I'm going to just create a fake company XYZ. I don't know if there's a company XYZ, but anyway, company XYZ, a fictitious company in this example, is the company that you own some stock in, let's say. So you own 100 shares of company XYZ. Let's say you bought those shares for $500, and today those shares are worth $2,000. So you have a cost basis of $500. You have a gain of $1,500. Your current value is $2,000. If you transition those dollars from your brokerage account to a new brokerage account, It is not a taxable event so long as you transition the shares in full. You do not do any selling. So long as you take 200 shares of company XYZ, I don't know why I picked 200. It doesn't matter however many shares it is. It's $2,000, but however many shares. Let's say it's 5 shares of that company. Those 5 shares go from your existing account to a new account. That is not a taxable event. There's no taxes for that. Very common question that I will hear from some folks is, well, I'm paying some fees on this account, but I don't really know why I'm paying these fees. It's not, there's no trades being made, nothing's really being done in that account, but I pay these fees, and I don't want to move it because I don't want to pay taxes. That's not a reason, because there again, so long as those you still own those shares, you can transition those shares of your stock from your existing account with fees to maybe a new account with no fees, and all you're doing is saving fees. There's no taxes, and if you're not going to do any trades or anything like that anyway, then I would agree there's no reason to continue to pay those fees unnecessarily. Okay, so this is another example of when taxes would not apply. Okay, so quick summary. IRA to IRA or other qualified 401k type of account to IRA, so long as you're the owner of both, no taxes. Roth IRA to Roth IRA, same deal, no taxes. Transitioning shares of a stock or an asset to another account, so long as those stay what's known as in kind, you don't sell those shares, that also is a non-taxable event. So you can transition those shares over. No taxes will be due. The only taxes will be due is if you happen to sell those assets down the road. And so that's all the non-taxable stuff. When will you see taxes? If you take a 401k or a TSP or a 403b or a 457 or any other employer-sponsored plan, and you transition those dollars out of that employer-sponsored plan that's qualified pre-tax, and you go into a Roth account, that's a taxable event. If you take any of those dollars as a distribution, meaning it hits your hands, goes into your checking or savings account, that's a taxable distribution. If you take the distribution as a 60-day rollover, you must first pay the taxes, and then you can deduct it afterwards on your tax return. But initially, it's a taxable event if you take a 60-day rollover. If you want to avoid the 60-day rollover, you go as a trustee to trustee transfer. Even if they send you a check, so long as that check is made payable to your new custodian of funds, an example would be maybe you have a 401k account with a financial institution of a given name. Let's make a fake one. Let's say the financial institution is ABC Brokerage. ABC Brokerage sends you a rollover check, but that check is not made payable to you personally. It's made payable to your new custodian, which is LMNOP Brokerage. So long as the check is payable LMNOP Brokerage for benefit of your name, then that is a non-taxable event. You don't have to worry about the 60-day rollover tax withholding. Okay, so that's how you would dodge that one. But if you take it as a 60-day rollover, you do have to pay a mandatory initial tax hit for doing it that way. So to avoid that, you want to have the check made payable to your new brokerage institution. Okay, another scenario where there's taxes due. You have a proprietary mutual fund held with the mutual fund company. So you own a international bestseller mutual fund. Okay, just a fake one. Okay, I try to stay away from specifics in this setting because I don't want to be at risk for providing some advice or something like that. Okay, so international bestseller mutual fund is your mutual fund that you own today. The international bestseller is the name of the mutual fund company. There's no such thing, but we're going to pretend. International bestseller. says we will not allow another brokerage firm to hold our mutual fund. If you want to transfer our mutual fund to another custodian, say LMNOP brokerage, if you want to do that, you're going to have to liquidate your shares of our mutual fund because we are the only custodian for our mutual fund here at International Bestseller. And so you say, okay, fine, I'll do that. So you liquidate because you want to get the money over here to LMNOP brokerage. Well, any gains that you've had, so maybe you bought that mutual fund for $500, but now it's worth $2,000. That $1,500 is a taxable event, and so in that scenario, you've generated taxes. So that's not too common. Okay, it's fairly uncommon for there to be proprietary mutual funds, for example, that would disallow you from transferring them to another account, but it does happen from time to time, and you should be aware of it. Another scenario that would cause you to pay taxes is if you sell the funds in advance. So let's say you want to get some money over into another account because you want to do some investing over there, but you don't have any cash. You don't have just dollars. You only have investments. Well, if you sell those investments to then send cash to your new account, the sale at your current custodian is going to, well, assuming it creates taxes, right? It'll create a taxable event, whether it's a capital gain or a capital loss, depends on your scenario. But it does create a taxable event. And so you would need to rectify that and have that in mind as these cash dollars now go over to your new account, because although those dollars are now over there and that's great, you may have to deal with some taxes on that. So that would be another scenario where you'd end up with a taxable event. Most transitions from one custodian to another custodian is not going to create a taxable event. Okay, so long as you handle it properly, I would say the majority of the time, probably better than 95% of the time, you could do it with no tax exposure. If you're doing it and getting hit with tax exposure, you should probably be dealing with one of these proprietary situations. Otherwise, somebody's making a mistake. Okay, so generally, this should not be a taxable event to transition between one account or another, so long as it's handled properly. Okay, I hope you found today's episode to be helpful. And with that, we'll wrap up for today, and we'll see you next time.